We've seen a host of positive data on China today, including year-on-year growth of 7.4%, along with seasonally adjusted quarter-on-quarter growth in annualized terms speeding up to 9.1%. But is it premature of us to see this as a major indicator that China is only a few months away from a full economic recovery? Well, on the line to discuss all this with me is HSBC Trinkaus' emerging markets analyst in Düsseldorf, Bernhard Esser. Thanks for joining me, Bernhard, today. Lots of China data out this morning, and as expected, it's been very good, with some analysts pointing to signs of a recovery in the fourth quarter. But shouldn't we be cautious about these figures, given contrasting PMI and trade data?
No, I don't think so. First of all, we have to realize that sequential GDP growth, that means quarter on quarter, rises up to 2.2% from 2% in the second quarter. That might be a first sign of getting close to a bottom of growth. The second thing is macroeconomic hard figures are improving over September, and I think, yes, we still have problems with the industrial sector, with the secondary industries, but overall investments are picking up, the private consumption is robust, so I'm very confident that we will see a mild recovery over the fourth quarter.
Do you agree that infrastructure has been the real driver here, where Beijing has opted for large investment in things like transport, for instance?
Yeah, absolutely. The recovery is utterly relying on infrastructure projects. We see a better environment. For example, it's more easier to get approvals for infrastructure projects. We have very good liquidity conditions at the very moment. So yes, infrastructure is the main driver, and of course, infrastructure means that's a short-term impact.
Now, we've got a transition of leadership on the way. What challenges will the next leadership face?
Yeah, there are challenges, of course. They are definitely there. They have to reconstruct the whole economy from an infrastructure-based growth model to a more consumption-led growth model. You might know that the consumption part on GDP expenditure is just about a third, investment is about two-thirds. So within an aging population, you should focus more on strengthening the private consumption within the country. Secondly, China definitely is on the brink from a poor workbench of the world toward a more research and development center, to invest more in innovations. So they have to face that growth rates won't be that high as they were in the past. And given that there is a contract between the people of China and the government to give the opportunity to become rich with economic growth, there are challenges ahead, yes, there are.
Finally, do you think Beijing will bother considering any further quantitative easing now?
Yes, I think they have to do so. But if you look on the industrial sector of China, the growth rates are low compared by historical standards. So for further recovery, continuous policy support is required. But I'm not so sure if they really use lower rates as a tool of monetary policy. I think they will more focus on liquidity injections and on a further reduction of the reserve requirements.
Bernhard, thanks very much for joining me. I'll be back tomorrow for a review of the papers in Friday's press review. But until then, goodbye.